anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? Till we fall asleep. The night is young, won't you sing for me? Won't you sing for me?
Hello, everybody. Welcome to VC Masters, only on the Pod TV network. I'm Nick Pallavita. I will be the moderator for today's show, but not the host of today's show. And of course, the host for today's show will be Dr. Salman Alzar, who's a professor at Duke University and also heads up the Opportunity Fund that we're going to look at today. But part of the things it's called the Azimuth Opportunity Fund, in case you guys don't know what it is, but he's going to be discussing that also. But what we're going to be discussing that I think is going to be very important coming down in the next, well, we'll see, it's up to Congress, is the new rule changes that we're looking at in what they call the Invest Act. So the Invest Act, in case you haven't followed it, for the people that are accredited investors, was passed 302 to 123 by the House. And this is kind of a game changer we're going to look at. First of all, accredited investors are like the only people that can look at these venture capital funds. You have to have predominantly accredited investors. And to be an accredited investor, you have to have a net worth basically of 1 million minus the value of your house. Or there's different definitions. An accredited investor could have an income of 200,000 single or 300,000 jointly in the last 2 years, expecting to have that income on a going forward basis. Or you can be an accredited investor if you're a broker dealer or an independent, you're an investment advisor representative, IAR. Or you can be a certain professional and you might be qualified as an investor, accredited investor. There are also certain inflation adjustments that they put in the act, which right now the SEC doesn't follow. But here's one I found that was kind of exciting. You can be accredited by way of examination. Now, of course, this act has not passed yet, but you can imagine that people who want to get into these funds who can't, they're going to have them take a test. And if they pass the test, then they can become an accredited investor. So I found that to be a very exciting opportunity in the Invest Act. There's also investment opportunities for 403B plans. Since in my other company, we do manage qualified plans, this is a game changer for us. And also the thing is they may have it in 401ks and profit sharing plans, because they want to open up this world of private equity and venture capital to everybody rather than it being just for accredited investors. They also plan to change the rules on the funds themselves, moving it from 250 to 500 investors in the funds, and also increase the offering limit, which is from 10 million to 50 million. And one of my favorite things about this is electronic delivery of documents. I do all my documents electronically because they're huge. You know, the files can be like 300 pages, and to transport them any other way just really isn't efficient. So with that, we're going to be bringing in somebody who actually does this work. Another Dr. Salman Alzar with the Azimuth Opportunity Fund. And Dr. Alzar, I find this to be a very exciting change that we're looking at that's very positive in the area that you're working in venture capital, because of the data that you showed us that the venture capital funds actually outperform the S&P 500. And the thing is, the problem is most investors or most people that are interested in doing it, they don't know where to go. And not only that, even if they could go to invest, then they find out they can't invest because they're an accredited investor. So what are your thoughts about this? Or is Congress moving in the right direction by opening up this world? And we're trying to open up the world using the Pod TV network as well.
Definitely. And I want to open up the world so that I can pass the wealth to more individuals. Right now, the rules, in fact, all financial rules historically in America, at least, have been that it is easy for you to make a little bit money, but it's very hard for you to make a lot of money. The less money you make, or want to make, the easier it is for you to invest. So if you want to keep your money in checking account where it earns 0.01% interest, you can have at it all you want. But if you really want to access VC, where the average returns are generally about 20%, and the good VCs make more than that, the bad VCs make less than that, just so that everybody kind of knows that it's not like just a 20% guaranteed return. These new laws make it or as they are coming down the pipeline, make it very easy for the individual to invest by expanding the access. And it expands the access both from a qualification perspective as well as the instrument perspective. So let's talk about the qualification perspective. One of the major changes is that based on your education, based on your knowledge, you can start investing in venture capital or higher return and higher risk assets. What that means is that if you are qualified and you have a degree in finance or accounting, or you have certain licenses, you can invest. Previously, it was only one kind of FINRA license, I believe, that allowed you to invest, and you had to have the certification as well. Now, in addition to education and different licenses, it also allows for you to take a test. Now, that test, I haven't seen what it is going to do, but effectively what it probably says is, hey, I understand that there are risks. I understand these are my recourses in case I'm swindled out of money, et cetera, but ultimately it is all going to be based on the test is going to be all based on your knowledge. So let's kind of pause here and make sure, we understand that based on your knowledge, education, or passing a test, you can now invest, or you should be able to invest in VC when this law is passed. So, Mr. Pallavid, your thoughts on that? Does that make sense? Anything that I'm missing here?
I think the bill makes a lot of sense. Right now, we got to see, things that go through Congress take time. We got to see what the Senate has to say about it. It looks like this has bipartisan support. And then the SEC has to draft up the tests that people have to take. So things move very slowly, but you're moving, I think, in the right direction to allow individual investors to actually invest in venture capital funds, invest in doing the things like you're doing, where they're not actually startups. You're doing late stage investments, and most of the market, most of the people are locked out of that market. They can only do trades in individual stocks have done an IPO. So you're out of a lot of the potential growth markets. So this would allow it. And then the thing is, they do have something in the bill that I think is good for the retirement planning community, and that's they're opening up for the investments to the 403B market, which is what teachers have. In other words, you don't have to put all your money in these, but you can put some of your money and have a chance to actually be very successful financially, where if you don't, your odds of being financially successful in the United States is frankly pretty poor. And that's one reason the stats I look at, the demographics, we have 50% of the population in the US have 2% of the assets. The top 1% has about 40% of the assets. So when you have such a wealth disparity, these poor people don't have a chance. So this gives them an opportunity through their retirement plans. I believe we're going to open up to the 401k to actually invest in some of these venture capital funds and private equity funds, which normally they're locked out of. And then, of course, the accreditation by way of examination. There are a lot of people that may not get to the net worth standards of having $1 million. Remember, I'm talking about the 50% of our population that have 2%. Well, they're locked out. And same with the income. They may not have an income of 200 to 300,000. So they're locked out also as well. So this way, if they are sophisticated enough and they're smart enough and they can pass the examination, then they'll have access to these venture capital funds. So I see this as a movement in the right direction, because it's almost like this. If you had a choice to put money into a VC fund or put it in a lottery, right now people put it in the lottery. That's not the good choice. Okay. And you don't have to take a test to put money in the lottery. I'm serious. You don't have to take a test.
Yeah, see, it doesn't make sense, right?
It doesn't make any sense. Okay. In the lottery, I examine
Yeah.
it. It's what they call a negative equity bet. Your odds-on favorite, you're going to lose, and the equity isn't there for you. In the VC funds, as you know, it's odds-on favorite bet. Okay, so you're betting on odds-on a favorite at a multiple of return that you won't get in a traditional company that's already gone through an IPO. So this way, it gives people an opportunity to actually experience what startups and venture capital can do. And I've done quite a few startups. As a matter of fact, looks like I'm selling one of my companies, which will be well into the 7 figures. And I'm like, oh, great. I got to figure out what I'm going to do with the money. So the thing is, but see, it gives people an opportunity.
Well, give it to us. We'll double it for you very easily.
Yeah. So the thing is, I got to close the deal yet, but the thing is, it looks like it's going to close pretty shortly. The thing is, there's opportunities out there that I think people need to have an opportunity to invest in, and all business owners know that their best business is the business that they founded. In other words, how do you say, if you talk to business owners, they want to know what their best investment is, they'll tell you it's their company that they started, every one of them, and then everything else is down the road. So this way it gives them an opportunity to invest in other people that have started their own businesses.
Exactly. So let's talk about retirement accounts for a second. I think that, so first of all, you could today, or last year, you could invest through your retirement accounts into startups, but they have to be self-directed. And that was really the key. So, my advice to our partners, our investment partners, is that always first max out your retirement accounts for VC investment, because we have high capital gains, and that they would not be taxed. You won't be able to pay, you won't have to pay taxes immediately. And ideally, you should convert it into a Roth before you invest, because then you pay taxes on the current value, not on the exit value. So for example, if you have $100,000, you convert it into Roth, you pay, whatever taxes you need to pay, 30,000, whatever. Now that 100,000 grows to $1 million at the time, by the time you start withdrawing it, and you don't have to pay any tax on that $1 million. So you can do that through companies like Alto IRA. In fact, we have had Alto IRA on the show. We partner with them. We have, I think, dozens of investors who have invested through retirement accounts, which is the best way to do it, because you don't get taxed on your capital gains now, or sometimes in what this expansion means is that you don't have to invest through self-directed accounts anymore. The way I understand it is that you can now invest through your employer 401k equivalent, 401k equivalent for nonprofits. So this allows now people like me who have X amount of dollars stuck in an employer retirement account to use that money and invest in startups. Right now, I can only invest in the public markets or bonds or things like that, or keep it in cash. Now I can take that money and I can put it actually in businesses that I want to invest in, not businesses that some dude sitting in Wall Street who is, not putting his own money in is doing the investing for me. And that's really the challenge there, is that a lot of managers on Wall Street make money on other people's money by simply fees and not based on the performance. Whereas VCs, we make money based on the performance of the asset through carry, and I can explain how that carry works. But bottom line is that this expansion of allowing people to invest their retirement money and also expanding the accredited investor definition to education and knowledge is huge. In fact, it reminds me of like if the only criteria is the net worth or income, there's a joke that I heard that what's the easiest way to become a billionaire? And the answer is inherit $2 billion, because you're going to throw away the first billion, and that is the time you will go to wake up. So those people who inherit $1 billion or $2 billion are all of a sudden accredited investors, and they have no idea of how to invest money. Whereas people who have knowledge about how investments work miss out.
Yeah, and we should talk a little bit more about the retirement accounts. You're correct. If you're going to invest aggressively, you want to do it in a Roth account, because then what happens when the money expands or you get a huge rate of return, you can actually take it out tax free. The problem in putting these accounts in your 401k, unless it's a Roth 401k, which does exist, that when you take it out, it'll be taxable. And so, let's say you get a tax deduction, you put get $100,000 deductible going in to a 401k profit sharing plan, but then it grows to $1 million. Now you're paying taxes on the entire $1 million. However, if you put the 100,000 of 401k Roth grows to $1 million, you can take the $1 million out tax free. So it actually is better to put your fast growing assets in Roth accounts generally than you would put them in a 401k or a profit sharing plan. So I think that if this bill goes through, we're going to start opening up the investment world more toward the VC marketplace, which we've never seen before. I also do like the electronic delivery of documents, because handling paper gets lost. We don't do anything, on paper. We almost don't do anything on paper anymore. Everything we do is electronic, and then we store everything electronic, because paper is horrible because it gets lost. Electronic right now, if you back it up in several different places, you're pretty good to go. Now let's also talk about Wall Street. I agree with you on Wall Street. They operate what they call AUM, otherwise known as asset under management fees. And there's one company out there that goes, we make money when you make money, come with us. Okay. Well, we kind of know this organization. We only make money when you make money. So if you put $1 million with us and it grows to 2 million, you'll make money and we'll make money. But here's what they don't tell you. I don't know how this ad ever passed the SEC. If we lose money, if you lose money,
we still make money.
No, we still make money. Okay. They don't tell you that. In other words, if your $1 million drops to 500,000, they still make money, even though you lost $500,000, because they get an asset under management.
Absolutely.
Fee, a percentage of the assets that are under management. And even if it goes down, they're pulling out the AUM fees. The financial services industry today, when I first got started 41 years ago, this was not the case. But today, most of the financial services industry is based on asset under management and also broker-dealer control. And so the thing is, they tend to look at, and it's very sad that this whole investor education we're going through on our program is generally not offered in any high school or middle school class. So you'll take all these crazy classes, but you'll never take investing, and you're never going to get rich unless you know investing, ever. It's just not going to happen. And if you did get rich from some other way, you'll be poor very quickly, because you'll find all the places that the people make money and you don't. So we do have an opportunity to make some changes in this particular area. So I do see this expanding. We're waiting for the Senate to take this up. I believe Trump will sign it. If it passes, it has bipartisan support. I found that to be good. I usually like, when I saw the Invest Act take place, 302 to 123 by the House. That means that both aisles are looking at. The Democrats like it because it gives working people a chance to make some money. The Republicans like it because they go, well, it's more ways for people to make money. So both of them have a shot at that. And if you're in this market, and some of the people we're talking to are into private equity, or they're into venture capital markets, it'll be a way to expand what you're doing. In my industry, a lot of the companies I work with have been taken over by private equity. I mean, it's amazing how much private equity has moved in, and the IPOs are moving out because private equity
Yeah.
can form faster outside of IPOs, which have a lot of regulations, rules, SEC requirements, FINRA requirements. You have to deal with the broker dealer to distribute. So doing an IPO is just not the easiest thing in the world to do. Doing a private deal, a lot easier. So I think you're going to see an expansion in the private equity market. It's just going to happen, and this allows other people to participate in this private equity market that just doesn't exist. So what are you seeing in this?
Absolutely.
What are you seeing on it?
Absolutely.
Look at 2027.
Well,
It's going to take place fast. Go on.
Yeah, no. So great thoughts. First of all, private equity is really sweeping in, and that is actually causing a backlog in terms of liquidity, and it is helping us get better prices because companies are not having an exit. So when private equity invests money in you, they usually invest money to grow you or to acquire a certain percentage of the interest. So they don't buy the company. There's very rarely do they buy the company completely. Actually, I shouldn't say very rarely, but if they buy the company completely, we have an exit as VCs. When they invest money in the company, we do not get our money back. So that causes a little bit of a liquidity crunch in the VC industry, which helps us get a better prices because we actually come in and give liquidity to VCs that are near the end of their fund, like the last year or so. Now, the asset under management, or AUM, that you are talking about is really a very interesting trap because a lot of times the investors are impressed with AUM. So if some company has $1 billion AUM, let's say, they think that is a solid company. On the contrary, what happens is that the money managers in that company are typically compensated by salary and bonus. And the bonus is related to how well they perform, but the salary is a cost that is a fixed cost. So in your example, when you said if you start with $1 million and you end up with $500,000, you have lost $500,000. That's what you think, but you have lost more than that because you're paying them the salaries of these people. And these people who are getting the salaries are not putting their own money in their own fund. How can you freaking ask other people to put money in your fund when you're not putting your own money? I mean, this baffles my mind in this industry. And unfortunately, and I hope this is on the test, unfortunately, most of the investors do not know because they say, they come to us and, say, what is your AUM? And I said, well, in this fund, we are, 20 million, let's say, right? Oh, I am only going with the top tier funds that have $1 billion. I said, you won't get the returns. You won't get the returns for several reasons. One reason is they're not putting their own money. Second reason is that it takes a lot for them to move the needle. If they buy 100 million of something, they are going to move the price on that stock, and they're usually investing in public stock. And I learned this actually from Peter Lynch's book, One Up on Wall Street, where he said that Magellan, he was the founder of the manager for Magellan Fund, one of the flagship funds. And he said, Magellan's problem is it has become so big that we can't really, move the needle without making big bets. And then when we make big bets in a company, we actually disrupt the supply and demand of that particular company. And now we can't move very nimbly because if we sell stock, it would depreciate value. If we buy stock, it would increase value. And we are basically competing with each other. Now, the same thing translates over to the VC industry. Our average check size is like $5 to $10 million. But let's say if we we don't write checks under $100 million, we don't capture those opportunities that are in that $5 to $10 million range. And if you're looking at $100 million checks, typically those kinds of checks go through a competitive bidding process. They don't go off market. Anytime somebody is selling $100 million, everybody knows it is not a network effect anymore. And so the advantage that we have of being in network, or if they had advantage of being in network, goes away. So the AUM, or asset under management, is a multi-layer trap. The first layer is that you lose money. If you lose money, you lose more money. And if you make money, you make less money. And on top of that, you are now investing in something that the manager is not putting their own skin in the game. Thirdly, these funds become so large that they can't really nimbly move and capture opportunities that are in the $5 to $10 million range. They have to go $100 million, $200 million into each of them. And by the way, it's also from an investor perspective, is that the minimum investment usually is $500,000 or $1 million. So like your average Joe or Jill cannot invest in them.
Mm-hmm. Yeah, and what you're saying is absolutely true. Once you hit a certain number, usually it's about 50 million or more, you're now in a more competitive environment in terms of bidding. When you're working with companies 50 million or less, that's where your opportunities are, because you're not in a competitive bidding situation. And I think the average investor doesn't know that. And so what they do is they jump on the larger funds, not realizing they're just going to get average returns. There's no way they're going to get multiples. It just isn't going to happen. The multiples are all going to take place almost always on funds that are 50 million and less. So we see the strike points to really be about $1 million to 50 million, not 50 million or greater. The other problem that they have is the disclosures. You know, when they do acquisitions, they have to make public disclosures on that. And so then that attracts everybody else into the market space. So I see that this is going to open up a whole new wave of investing, which will be the basically the $1 million to $50 million companies that will be heading in toward the VC market, which individual investors for the first time can actually invest in, for companies that can explode in value, which you just don't have when you have a mature company. And this way, the non-accredited investors, which we know is probably about certainly 80% or more of the population of the United States, probably more than 90%, that are locked out of this market, will finally have a chance to invest in it. So this is going to be a big swing that will take place, maybe starting, third quarter 2026. Because remember, Senate still has to pass the act. Then according to the Securities Exchange Commission, has 180 days to write the rules. So that's the reason I figure, well, this will probably come about around the third quarter if they move quickly. And nothing moves quickly in Washington, D.C. It just doesn't happen.
And if there's a government shutdown, it pushes, like 1 month of government shutdown is going to push 2 weeks out. 2 months out.
It's most unfortunate, but the thing is, everything all the opportunities, it comes from Washington, D.C., but also the same disincentives also come from Washington, D.C. So we always have to track Washington, D.C. And so we're tracking this on the Pod TV network, the Invest Act. I don't know where it's going to go. We're also tracking the tariffs. We had the person who was the lead counsel that sued the Trump administration, saying the tariffs were illegal, was on the Pod TV network when he originally filed the suit. Because I picked it up, I said, this actually has merit. And we're still waiting for the Supreme Court decision. We picked them up in September of last year. This is how things move.
Awesome.
In Washington, slowly.
Yeah. So that tariff uncertainty, by the way, is delaying some of our IPOs, or some of our companies to IPO. And then there was another company that was going to IPO sometime this quarter, but it about a month of SEC shutdown pushed it like 2 months out, because restarting SEC and getting the momentum back took another month out of the whole thing. So it really, a month of SEC shutdown pushes IPOs by about another month.
Yeah, and these types of investments could be good for retirement plans because of the window of 3, 5, 4 years, or 5 years or more. Usually when we do a retirement plan for a client, we're looking for like a 5 to 10 year horizon minimum in terms of a whole. It's not for the person who's listening to this who's a day trader. Okay. The retirement accounts are usually 5 to 10 years as you're looking at the hold period, not I'm going to day trade. If you're going to day trade, do it in your separate individual account. If you want to invest, you do it in your retirement account and look for a 5 to 10 year hold. And with that, we're going to hold on just a moment and leave you. So we want to thank our viewers in the United States and also our viewers around the world for listening to VC Masters only on the Pod TV network. We'll see you next time. Bye-bye.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like starting over. Just let me